do. Except I've got intentions.
All right, it's official. I'm live. You know, I'm only going live because I got my hair cut today. No, I'm just kidding. Totally kidding. I have some super important information to share with you. And it's some information that, you know, we probably like once a week I get asked to look into someone's mortgage and consult with them on whether or not they should do a cash out refinance or if they should do a home equity line of credit. A recent client, aka friend, hi Tina. So Tina came to us. She had a mortgage in the conforming loan limit, so let's say under 424, and she was wanting some cash out to do some home repairs, debt consolidation. And whenever I approach a case and I'm being asked my opinion, it's always best to look at the pure numbers. And many things go into that evaluation too, such as, you know, if you've had your loan a year or two versus having your loan for 10 or 12 years. So let's look at Tina's particular file. So Tina wanted to cash out about $35,000, and we were able to refinance her and have her payment go up about, I want to say like $100, maybe $75. She had a really low rate already. She had like 3.5, and I cashed out, refinanced her to, I think, around 4% or 4.1. And I was really, you know, I didn't want to do that because 3.5 is beautiful, right? It's a beautiful rate. However, when someone has a specific need and you're asked to perform an evaluation, you have to, you know, she needed that money. Her roof was gonna, and you know, in Upland, we have a wind problem here, and she had some tiles blowing away, and she got this really great house, a 50s house, and it had 3 layers of roof on it already. So she had to have the whole thing redone. So I told Tina, hey, let's, you know, maybe you would benefit from a home equity line of credit because you have that sexy 3.5% rate. And so I don't do home equity lines of credit. It's not something that I offer the best or lowest term. So I often will, you know, if there's something that I can't do, I will refer it out and, you know, let people know, hey, I don't do that really that great, so you might want to try over here or over there. So we called around. I called around several places because Tina was way too busy to bother herself with her own transaction to see if this HELOC would benefit her versus the mortgage. No, I'm teasing. I was happy to do it for Tina. And then I was also really curious, you know, as a consumer calling around what the different institutions were offering. I found no fixed rate product. I found only adjustable product. And the adjustable seconds were in the mid 5s to maybe low 6s, depending on equity position and credit score. And then they were all adjustable. And, you know, seconds, it's when you're evaluating what's best, you also have to look at the term. There are, you know, seconds that are amortized over 30 years. There are seconds that are amortized over 15 years. So depending on, or 10 years even, depending on the amount of money that you borrow and the term that you want to pay it off, or the term that the institution chooses to have you pay it off, will make a difference in the payment. So with Tina looking to get $35,000, I was thinking that probably a 20-year loan would work for her. Now, she had her loan a couple of years, but again, it's 3.5%. So I really wanted her to keep this loan. When we looked around at the different product, a loan for Tina to get the second over a 20-year period would have been like high 5s. I think it was like 5.8, might have even been 6.1. but the payment was about $160, $170 for her to access that money and leave her first in place. When we went over that with her, she really had no interest in paying more, even though she would have had that loan, paid off faster, even though she had that sexy 3.5% rate. So for Tina, it made sense. Hey, let's do the cash out refinance. Let's keep everything low cost and satisfy the need to get money. I've had other clients, however, have their loan in place for 20 years, whatever the rate is, 4%, 5%, or not 5%, like 4%, 4.5%. And, when you've got 20 years left on your loan on a 30-year term, you're really getting into heavy principal payment years. And especially if you're of a certain age and looking to retire in this home, it's not just pure money that goes into all these variables and in figuring out what's best for a client. It's also, other factors too, like what's your end game? What's your end game for the property? How long are you going to be there? Sometimes what I think in the beginning when I go into a transaction, and then we get, after we've consulted with the client and looked at the numbers, just kind of what I thought from a gut, it turns out that it's not what's best for the client, just because everyone has such, specific needs and wants and end games. I mean, everybody has kind of like a different end game at certain stages of your life. So if you're looking to cash out refinance and we're wondering, hey, should I get a home equity line or should I cash out refinance? Give me a call and let me help you. We don't have to run your credit. I can just kind of, walk you through it, talk you through it. And if a home equity line is better for you and your family, it's a lot easier to come to that point when you have someone else on the other end of the line that, really knows all the other options available. So you pick up that phone and you give me a call. I'd love to help at 909-920-3500. All right, so I'm told that on live video, you don't look at the feed and answer questions when you're doing the video, but you can look afterwards. Let's see. Are there any questions here? But how about that hair? I'm just saying. Okay, let's see. Oh, we have quite a few comments here. Mostly everyone's saying hi. Hi, thank you for joining today. And if you have any, if you don't have a specific need, but you have a friend or family member that are talking about it, if you could think of me and mention my name, I'd super appreciate it. HELOC rates are going to keep climbing. 3 to 4 rate hikes expected this year. That's a big consideration. Thanks, Justin, for bringing that up. That's a big consideration for a lot of people. A lot of people don't want adjustable loans, and myself included. I mean, when you know that rates are going to go up, the one thing that we don't know, however, is how much. When the feds hike the rates, it doesn't have always have a direct correlation on where mortgage rates go. I've seen rates, the feds have a rate hike, and then shortly after the mortgage rate softens or even goes a little bit lower. But I think the consensus is rates are going to go up. Inflation is happening. The economy's, moving along at a really nice pace. So rates are going to go up. I don't think that they're going to go up a lot. I do have people, when they're considering a home equity line versus a 30-year fixed, oftentimes they'll choose to consolidate it into a 30-year fixed, even if it's a little bit more, just because they don't want that adjustable. The fear of unknown for a lot of people is too much. Jeffrey Sargent, wow, great information. Thanks, Jeff. All right. Okay, hi, Maria. Mwah. Thanks for getting us that stuff today. We're going to have your loan closed in like a minute, just so you know. A minute, maybe like 2 minutes, though. Okay. All right, y'all. I'm going to head on home. I've got an hour drive. I'm like a rookie commuter. So have Have a wonderful Thursday. And remember, TDR Mortgage and Real Estate for all of your mortgage needs. Now, if we could just stop this, finish. All right.